So one of the things you folks touched on was this, and hinted towards, was this potential distressed portfolio that now saddles a lot of these funds. And one of the interesting findings from this most recent survey is that approximately 84% of mezzanine funds and private equity groups report that they relied on an exit multiple that was the same as their entry multiple. Well, if they're buying in very euphoric times when these multiples are elevated, they're relying on getting out at fairly high multiples too. And with this new economic change, naturally, we've seen a significant contraction of these multiples, which has created a lot of strain on the portfolios. And ultimately, what we're seeing are a lot of distressed transactions and opportunities coming available here. So on that note, what are some of the hot sectors for distressed transactions these days? And will the wave of distressed M&A continue beyond this year? What's the outlook here?
I'll start. I think one of the factors you've seen is that there has been, from the private equity fundraising point of view, the most successful funds in the last year that have been raised for distressed debt, special opportunities situations. So people believe that there's going to be value coming. Whether that value is here today or it will come over the next couple of years, I think remains to be seen. I think one sector that's probably received a lot of attention has actually been real estate, something we've, in our business, we're not 100% focused on, but the opportunities out there in commercial real estate to get marquee properties that have just been over-leveraged, and over time the belief is that they can create value. I think that's the sector that's probably seen the most activity in this fall.
Yeah, I mean, it's interesting. We went 14 months without making an investment. We were really, end of 07 time frames to the beginning of 09. Were we lucky? Were we smart? I'd rather be lucky any day of the week. But we tried to acquire things in 2008, but the multiples got away from us, and we were very fortunate on some properties that we didn't win. And so what does that mean? Again, we only look at media, entertainment, communications. I think there's distressed assets in that play, in that arena, simply because people were very acquisition happy, investment happy during those times. One of the focuses that we have done as we take a look at deal flow is we're talking to all the lenders. You're getting to the point where the lenders are taking the keys. They've been trying to prolong it as possible, not wanting to take write-downs like the private equity guys because of FAS 157 that that we've been subject to as an industry. But the lenders are now starting to say, okay, how do I get my capital back? And whether they have taken over the keys or not, they're starting to turn to a new private equity firm for capital to help grow these companies, because they don't know what to do. They don't know how to manage them. That's not their business. It is not to operate these entities. So within media, entertainment, communications, again, select individual sectors. I think there's going to be distressed plays, and that's where I can comment on.
From the banking side, banking has changed fundamentally, over the last 20 years. Years ago when I was at Imperial Bank, say, you'd have a distressed loan. It goes to work out, and their goal is just to get rid of it as fast as possible. Bankers aren't trained to be private equity folks and manage these businesses. Today it's different, and it's a function of two things. A, bankers are generally getting smarter and more astute of what's in the portfolio. And B, I think they've just got so many distressed cases on their books that they're forced to be astute and smart. But distressed investing is cyclical. It comes and it goes. And this has been a huge wave. But distressed investing is dangerous. It's like catching falling knives. You're going to get really bloody before you actually catch one. With the credit markets falling apart in 08, there was incredible value. And in this past year, high yield and leveraged loans were up 50% each or thereabouts. Going forward, I don't know if there is good value. Maybe there is, maybe there's not. But it's probably only going to be around for a while. I wouldn't put a lot of stock into it. I kind of stay away from it. But again, I think the point here is bankers are being more active in their distressed portfolios. I think it will provide opportunities for PE firms to take these companies off our hands at reasonable multiples but I clearly think you're going to see more bankers foreclose, taking over companies, being more engaged just to maximize the value. Because that's their job, frankly, today. It's portfolio management, minimizing losses.